So previously we did a video on buying MSTY and showing what your account would look like with the drip on and drip off. We used the worst case scenario of the closing price of $44.40. But what if you bought MSTY at a much lower price than at the top? Stick around, we're going to plug those numbers and see what the outcome is. Hello my friends, this is Legend. So previously we did a video and we were using the buy date of November the 20th for our buy date there, and that happened to be the highest price day, so therefore that would be the worst case scenario to use, as if you bought them at the high, not the ultimate high, but the highest closing day, and then we're trying to get your capital back, or you had the drip on to accumulate the shares. But what if you didn't buy them at the high? What if you bought them more around the $25 range or something like that? What would your account look like then? And that's what I want to punch in for today. So let's just go ahead and jump right over to the spreadsheet and let's have a little bit of fun. All right, so here we are back on the spreadsheet, and this is the same one we were looking at before. And as you can see, we had that start date of November the 20th. And if we go over to the Webull chart, I'll show you what I mean by the highest price. All right, so here we are on the Webull chart. And as you can see, this is the highest candle for MSTY. And it got as high as $46.50, but it did close at that $44.40. That is using one of the highest price per share costs for MSTY. And that's what we were using for that sheet before. But what if we use that lower price? So let's just see what's a good price here. And I'm thinking somewhere around that maybe $25 range. And that's what I've got this little dotted line here at. So we can just slide over here and we'll say, well, what if we got into MSTY on this little red candle day right here? Okay, it was going up a little bit and then it dropped back down and it dropped below that 25, and for us that was the moment to buy in. And that price is $24.42. So we'll plug in the date of 10/1, October the 1st of 2024, and we'll see what kind of values we get. All right, so to do that, all we have to do is we come over here on our start date and we're just going to enter in October the 1st of 2024. Once we hit enter, it recalculates and there we go. Now we have that first date shown as October the 1st, and there's that $24.42. We still only made that initial 100 share purchase. The total distributions we will have earned was about $2,200. The drip is off, so we are not reinvesting. So in this case, we are keeping our distributions. The account value, and this is basically the number of shares times the current price of MSTY. And the current price of MSTY on this sheet currently is $21.15. times 100 shares is $2,115. Account value with the distributions, that takes into account the actual price appreciation or depreciation, right? So the account value plus your distributions you've made, and that gives you a total account value, including the distributions, of $4,370.95. The capital we spent was our 100 shares times our buy price of $24.42. Therefore, we spent $2,442. Now, the capital at risk, that is the amount that we have spent. All right, so that's how much you spent. And then how much have we earned back? Well, we've earned back our distributions. So that's how much we've gained back out of the account. And take the difference of those two, we would be sitting still at risk of $186.05. And that means that we have almost earned back all of our distributions. We've almost earned back all of our capital in the way of earning those distributions. Now, once this gets to zero, then that would mean that your total distributions right here would be equal to or more than the amount that you have spent, and that's the capital that you have spent. Then therefore, this number will go zero or will go positive, meaning now you are gaining money even above what you've spent to get into the ETF. Now, that does not account for the account value, meaning the price of MSTY, because the only reason you would look at that is if you were looking to sell. And if you are, then that's fine. You have this value here then that you're looking at. And that's the account value with the distributions, meaning it's worth $4,370.95. And if you only spent $2,400, then you could technically sell it at the current moment and you will be profiting that difference. So it is not a losing trade currently, right? You've made money. And once this capital at risk, once that goes to zero, and even if you don't buy any more shares, all that capital coming in is free and clear. And you can use that then and roll it back into MSTY or buy other stocks with it or whatever you want to do at that point. That is your choice, but the only amount that you would have invested at that point would be the YieldMax distribution money, not your grocery money, right? All of that is back into your pocket. And I don't know about you, but that does get me a bit excited. So we had our original purchase share price of that $24.42 right here. Our average price per share is the same thing, right? Because we did not purchase any more shares, just that one-time initial share price purchase. And therefore, our adjusted price per share is $1.86. Because all that means is whatever you have still at risk divided by the number of shares gives you the share price for your adjusted price per share. And that's your real price per share value, in my opinion. So I think everybody can agree that unless you bottom all the way up toward the top and you bottom close to around that 25 or lower, and that's only been 8 months in, right? You have almost earned all of your money back in distributions. Now, the reason I say that the share price does matter is because that was a purchase of $24.42. And if we bought it before or after that date, or a higher price or a lower price, because if it's a lower price than $24.42, then our capital at risk will drop even more. And we may even go positive. And what would be that price that we would be looking for? And that would be basically, you would need somewhere around that $22 range. Because if we've earned back $2,200 in distributions, and if we bought it at a $22 price per share, then therefore the capital spent would be roughly the same as the distributions we've earned. So therefore you have earned back all of your capital. And that is exciting. And that's also why I don't like to purchase shares above my average. But if you are increasing and you're buying whenever, then that's your choice, of course. But if you are raising that price per share, then your average price per share will be increasing. Therefore, you will need even more distributions to offset that and to try to narrow that gap. Well, before we switch the dates just to see what those would look like, let's just go ahead and throw on the drip for this example here before we change that date, just to show you a little bit of more proof that it does kind of matter the prices that you do buy these ETFs at. So let's just go ahead and turn on the drip and say that we're going to drip it all right back in, which will increase our number of shares, right? Because we are dripping it right back in, and that will help to bring that average price per share down because you'll have more shares that will be part of the equation. So let's just go ahead and turn the drip on, and let's just see where we're at. Right now, we currently have the drip off. We have almost earned all of our capital back, and let's just see where we're setting with the drip on. Okay, so with the drip on, of course, our capital at risk is the amount that we've originally spent, and that's that $2,442. You have upped your number of shares to 221 shares. The total distributions you've earned is $3,174.79. So by dripping, you've increased the number of shares you own. The distributions you've earned is more, right? You have increased those distributions as well because you're multiplying each distribution pay rate by more shares each time, which gives you more distribution earned. But with the drip on, you're not capturing this. You're actually taking it and rolling it back in, and that's how your shares are increasing. So what is your account value? Well, your account value is $4,689, and that is the price of the stock times the number of shares. Your account value with the distribution, well, it's the same thing, right, as the one above, because you have not really gathered or captured any of the distribution. It's rolled right back in because you're accumulating and building your shares. And that's the only reason why you would have the drip on. The capital spent, well, that's the amount that you originally spent, and that's that $2,400, just like before. But the difference here, of course, being that capital at risk, is still the $2,400. Now, if you were to sell out of MSTY, right, and just go ahead and pull it out, then you would have gained the difference between your account value here of $4,600 minus your capital that you spent of $2,400, and that difference would be what you actually earned, right? But in order to do that, you would have to sell. And what also affects the account value here, and that is what your account on your broker sees, is the price of MSTY. So if you are rolling your distributions back in just to build up your shares, that is your choice, and that is what a lot of people are doing so that they can build up their shares. And that's fine. If that's your plan, then that is fine. That's your choice. You're the boss of your portfolio. But do note that account value right here, that is the important part for you, because you do not want this account value here to start dropping below what you've actually invested into the stock or ETF. In this case, you're still up about $2,200, right? $4,600 minus the $2,400, about $2,200. You're still up, so that's what you could capture, but that does mean that you're selling out of it. And if you're not in a place that where you want to sell, then the price and current price of MSTY would matter a little bit more if it was to keep going down. Now, the price of MSTY going down also could mean buying and getting a better price, all assuming that MSTY will go back up. But nobody knows the future, and that is why I am not dripping. That is the simple reason why. Because I do not want to put all of my eggs into the price of MSTY. Because if the price of MSTY drops, and it happens to drop down to $5, I'm not saying it is, and I don't think it will, but all of that is just me guessing, right? That's all of us, right? Nobody knows, because if Bitcoin goes into a winter phase, we don't know what MSTY will do. MSTY has not gone through an event like that before. MSTY has only been around why Bitcoin has been going up for the most part. Now, don't get me wrong here. I am just talking, right? I am just talking and thinking out loud about what the potential pitfalls or potential losses could be. And that is why I am looking to gather my capital back. So then, no matter what that distribution payout is, it's still a gain in my account. Now, my account will show down because I am not dripping those distributions back into MSTY to help lower that cost per share. But instead, I'm actually holding those distributions. Now, when I say holding, I mean I can be reinvesting them, right, into something safer, into, say, VOO or something like that, or whatever I choose, just for holding. But I am gathering and holding those distributions so that once that equals or is greater than the capital spent, then I no longer have to worry about what and where MSTY will be going tomorrow, the next day, a week later, month later, year later, 10 years later. Now, if this thing just keeps on going, then by you dripping those distributions back in to purchase more shares, you're going to have a massive amount of shares and your distributions will be quite nice. But keep in mind, it still takes time to get your money back. Even if you are making $10,000 a month on distributions, and you still need those distribution payouts and the time in order for those distributions to equal or be greater than the amount that you have spent. Now that works whether you're using the drip or not the drip. That's just the function and the downfall, if you can say, of these higher yield ETFs. You must put the time in to gather your capital back in the form of distributions. Now, you can gather it back in the form of price appreciation if it goes up, but that would mean that you would be looking to also sell shares of MSTY. And if that's your plan, then that's your plan. But for a lot of people, including myself, I wasn't necessarily wanting to sell MSTY. I'm looking for that monthly income. If I can say monthly income, I know it's every 4 weeks, but just to keep it nice and simple, I'm looking for that monthly income. And once I have got all of my capital back, that monthly income is then an actual increase in my income. But I have to put the time in to allow those distributions to repay me what I spent. And no matter at what point you decide to stop buying and allow the distributions to start paying you back, you have to do that. It's just, when do you start? And for each one of us, that is different, and that is perfectly fine. I'm just looking to try to get my money back as fast as I can, and then I can build up the account with the distributions. In a sense, I can turn drip on after I have received all of my capital back. If I wanted to use drip then, I can turn drip on, and it will be no money out of my bank account, right? My personal money that's invested here. This would be all YieldMax distributions coming in that was above and beyond of what the capital I spent to get in. So in a way, I will be doing the same thing. I'm just looking to get my capital back, get my money out, get my skin out of the game, and then build it with the YieldMax distribution money. Because if this thing's going to be around for 10 years, then that is great. But if it's only going to be around for a couple years, I want to make sure I've got my money out, and then I'm growing MSTY by using YieldMax money instead of my hard-earned capital money. And just to give an example here of if you do buy at a even lower price right here, and we were looking at that 24.42, and that was on October 1st. Let's find a date that had even a lower price. I've heard some of you out there with around a $20 per share price. Okay, here we are on the Webull chart, and as you can see, on September the 9th, price was at a close of $20.53. That's pretty close right there without doing the $18.94, right? That would have just been you getting lucky and buying it at that low of a price. But I have seen some of you out there stating that you are around at that $20 average price. So let's use 9/9 date and let's see what it changes on the chart. So we'll go right here and we're going to enter in 9/9 of 2024. Now this is with drip on. Again, we're increasing our shares. We got 241 shares. You're still reinvesting your distributions. Your account value now is $5,000 and you've only spent $2,000. But what if you weren't dripping? So let's turn that off and boom, there we go. And that's what I mean by it does matter when you buy, because we bought at that $20.53 down here on 9/9. And now our capital at risk, well, we have none of our capital at risk now. We have actually exceeded the amount that we have invested by $388 because the amount that we spent, $2,053, the distributions we've earned is $2,400. Therefore, we have earned above and beyond what we spent of $388. And that right here is exactly what I'm talking about. So now, no matter what the price of Misty goes to, I am not worried about that part. I am not worried about it. That $2,115 of the account value, meaning that is the number of shares times the current value or the current price of Misty, it doesn't matter, because no matter what that price of Misty goes to, I am still going to be earning distributions. They're not going to be removing distributions from my account. So if they pay out anything, this will increase. Therefore, my amount that I'm making will increase. And if Misty continues to go up, the distributions go up, then I just make more money. And that's the beauty here. I no longer have to worry any about the price of Misty. Now, as the price of Misty, of course, goes down, the distribution pay rate will also decrease, and the price of Misty, of course, goes up, then the distribution pay rate could also go up as well. But either one, like I said, I no longer have to worry. And I've been in those situations where I was trying to build up my number of shares so that whenever I stopped, those amounts that would be coming in would just be astronomical, right? And that is why I am playing this one a little bit differently. I'm playing it more on the safe side. I've got an amount vested in there, just like everybody else, but I'm looking to use the distributions to pay me back, and then I can just sit back, I can turn on drip, I can use the distributions to buy when I want to buy, whichever way I want to do it. I can use a percentage of it to buy more Misty and another percentage to buy into VOO or any other stock. Or I can use it to pay my bills. I can do whatever I want at that point because that is free money coming in. So I just kind of wanted to really clear up that because on the last video, we did show it at the basically worst case, almost the worst case scenario, right? You bought it near the top, and whether you were dripping or not dripping, you still had a nice chunk of change still at risk. But if you didn't buy it at the high, and of course if you did buy it at that high, then you may need to have been buying at the lower dollar values to help bring down your average. And of course that is not financial advice. It's just thoughts here. I'm just giving out my thought and then setting and then capturing those distributions. But that's why I am doing what I'm doing. And that's why I also wanted to do this one on a more somewhere in the middle buy price versus the video before of almost the worst case scenario. This one here being a buy price of even at the $20, and the before we were at around $24 to $25, is more a line of what a lot of us are at for our purchase price per share. So it is kind of exciting, isn't it? I mean, just to be able to know that once you get it paid off, those distributions coming in from that point are just free and clear, not taken into account of any taxes or any fees or anything like that. That is something that you have to check with your tax advisor and figure that into your equation. But this is basically how I am working it as I'm looking to get my money back. And then I can set nicely and let it grow. Super excited, guys. Super excited. This is great. This is some fun times. And if you use these YieldMax ETFs, not all of them, but some of these better ones, if you use them right over time, they can treat you right. But you do have to handle them with care because it is still a one stock ETF and it is a lot of money on one stock. Never forget that. A lot can happen with just one stock. So I think I'm going to wrap it up right there. So if you don't mind, hit that subscribe button and smash the like button. It'd be much appreciated. And as always, I am not a financial advisor. This is not financial advice. Please do your own due diligence before you get into any stock plays. And until next time, Legend out.